Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know this morning.
First up, U.S. stocks kicking off the month in the red. The weak start to the month coming after the S&P 500 closed out its best May since 1990. Of course, that coming amid strong tech earnings on Wall Street and an easing in trade tensions. But for investors wondering how June typically performs, it's not so good. Data going back to 2000 show that June is historically the third worst performing month for the S&P 500.
Plus, U.S.-China trade tensions are heating up. Over the weekend, China responded to President Trump's claims that China has violated its agreement with the U.S. China now says the U.S. has violated its trade truce and is vowing to respond in kind. And sticking with trade and tariffs, steel and aluminum stocks are on the move this morning. President Trump says he's doubling levies on the metals.
That's right. Investors also looking ahead to big economic data this week. The May payrolls report is expected to show that 125,000 jobs were added last month. That is well below the 177,000 jobs that were added in the month of April. Markets will be watching closely for any signs that the labor market is worsening due to tariffs and broader uncertainty around trade policy.
U.S. stocks sliding this morning amid growing trade tensions between the U.S. and China, the world's two largest economies by GDP. China now accusing the U.S. of breaching their trade agreement, echoing President Trump's calls that China violated the truce. All of this adding pressure to stocks as they kick off June trading. Joining us now for what to watch this week and what Wall Street has to say on the trade front as well here, Yahoo Finance Markets reporter Josh Schaefer here. What are we hearing? What is the pulse check of the street as we're hearing now this spat again reemerge between the U.S. and China?
I think, Brad, you're just seeing the market maybe kind of continue to look through some of these issues, right, as they come up on a minor level, and that's what strategists have been talking a lot about at this point. I know Piper Sandler's Michael Kantrowitz was pointing this out, that maybe we've reached a point where the market just isn't moving at as much of a dramatic stance on each little tariff headline, right, and sort of getting to a point where market is saying, okay, we're kind of comfortable with the fact that this tit for tat, this back and forth is where we are. I think you saw that on Friday, right? You didn't have that large of a sell-off considering what's going on. Then you're seeing that again this morning. These headlines, if you think back to a month ago, were moving the major indexes by probably over 1% on any given day, and you're just not seeing that movement anymore. So it seems like the market, at least for now, has kind of taken this and said, okay, this is the world we're living in. We're not going to overreact to every little headline that we're getting at this point.
And especially as we head into June, that's a historically lower volume month. I wonder how offsides investors may be caught by tariff headlines coming in worse than anticipated, given that they may be out to vacation and not necessarily as involved.
Yeah, it definitely feels like there's been some optimism, right, coming into this month as far as just the overall tariff story. I think to your point, Maddie, we were speaking to some strategists on Friday on the afternoon show, and we were sort of saying, well, it seems like we're positioned at this point with the S&P 500 almost back near 6,000 for good tariff headlines, right? And so the risk being tariffs get escalated further from here. The tariff rate that is anywhere estimated from maybe 14 to 17% right now actually goes higher and doesn't move lower. Definitely a risk that's out there. And then the other key risk, of course, as we sort of look forward to this week, continues to be the data, right? Does the data eventually actually turn economic data? I'm talking about, does the unemployment rate go up? Do general growth numbers that you're looking at start to get worse? That isn't something we've seen yet, but that seems to sort of be the risks lie on either side of that headed into this week, right? Could the jobs numbers continue to come in better than expected? Does the data ever actually never turn that much? And that's sort of your bull case scenario, or the data actually do start to turn, and then you get into a scenario where it's, okay, how bad is this really gonna get? And I think that's sort of, as we enter June after a pretty good May, the two sides we're looking at this point.
You know, I was taking a look at a blog post from a good friend of the show, Joe Brusuelas, who joins us regularly, especially on some of the economic data releases here. And he was talking about and focusing in on tariff mentions, especially among some of these mid-market firms here. We talk about the companies that were able to get their shipments in ahead of some of the onset of tariffs and on the threat and announcement of tariffs. But you think about those mid-market companies who this impacts a little bit more, and 5,071 mentions versus the 91 that we had seen in May. Just since last August here.
Yeah.
And so the consideration of that and how investors should be thinking about that, given the small and mid-cap plays that they've heard about since the start of this year.
Look at the equity market performance of the last month, Brad, right? If you think about what's been happening in the stock market has been telling you pretty similar to what you hear on those call transcripts, right? So if you look at, say, the Mag 7 over the last month, that index is up 10.3%. S&P 500 was up 5% in May, right? So double your performance for large cap tech that might be able to navigate tariff headwinds a little bit better. Then you look over to the small cap Russell 2000, that was up less than the S&P 500 was up over that month, right? So you've seen this sort of from a cap spectrum play out, and I think there's a clear stance from market participants that small and mid cap firms are definitely more exposed to these tariff headwinds. They're also more exposed to the higher rate story, right? And we haven't seen rates come lower. So you've seen a large cap bias. DataTrack was out this morning pointing out that the Mag 7 themselves from Q2, so start of April through May, are worth 70% of the S&P 500's gains. We're back to that story a little bit in markets right now, and I do think that is a tariff story, it's a rate story, and then just look back at earnings season. Most of your year-over-year earnings growth for the S&P 500 once again came from 7 large cap tech companies, right? So you're back to that story right now. The key turning points that we were just talking about that gets me, how do I get back to my smaller mid-cap play, right? Is it soft data starts to turn, right? So that survey data starts to get a little bit better, and then does hard data follow? I was talking to Citi strategist Drew Pettit about this last week because they favor large caps. I said, well, what makes you change your narrative? And he said, I need to start seeing some better survey data, maybe something like ISM out this morning. Better survey data comes first, then hard data starts to follow. Then I need to start looking into some of these smaller mid-cap areas. But I think we have a little bit of work to do before we get there.
And to your point, that large cap outperformance is now starting to make the stock 600 look a little bit less attractive and falter a bit compared to U.S. equities. So interesting to monitor that, Josh. Thank you so much for joining us. Appreciate it. Well, days after a closed-door meeting at the White House, Federal Reserve Chair Jerome Powell set to speak at a Fed event today at 1 p.m. Eastern ahead of a week chock full of economic data. Powell's comments coming after Fed Governor Chris Waller said he could support rate cuts later this year, provided inflation continues its path towards 2% and the labor market stays solid. I want to bring in Gus Fauché, PNC Financial Services Group's chief economist. Gus, great to have you here this morning. Talk to me about your view on the status of the current labor market, because we have had some sources telling us that there were cracks in the labor market even before these tariffs were another form of uncertainty impacting the economy.
Yeah, we had seen softer job growth in 2024 and so far in 2025, but the labor market remains in good shape. Unemployment rate is 4.2%. Job growth this year has been slowing, but that's consistent with growth in the labor force. And then initial claims for unemployment insurance remain low. We've had a couple of weeks that are a little bit higher, but we haven't seen a consistent increase. So I would expect to see job growth sometime for May of about 140,000 when we get the jobs report on Friday. Unemployment rate of about 4.2%, staying where it was in April, March and April. And so I think that, generally the labor market looks to be pretty solid.
And what about wage growth in correlation to what we're still seeing in inflation prints, Gus?
Wage growth has been slowing as job growth has eased. That's good news from an inflation perspective. It's bad news from a consumer perspective, right? So if wage growth is slowing at the same time prices are increasing because of tariffs, and that is going to be a drag on consumer spending. But from an inflationary aspect, that's good news. And I think wage growth is slowing to a pace that the Fed thinks is more consistent with their 2% inflation objective.
Do you think that inflation is slowing towards that 2% goal still?
Well, it was. I don't think it's going to. I think we're going to reverse some of that progress in the near term as higher tariffs make their way into the CPI and into the PCE price index. I think we will see higher inflation in the near term. The question is this a permanent increase in inflation like Governor Waller was talking about, or is this just, or is it a one-time thing, which I think is what Governor Waller was talking about? And the Fed is going to wait and see on that. They want to see do we think that the inflationary impacts of tariffs are going to just fade away after a few months, or are they going to last more for a longer period of time, in which case rate cuts are on hold, into late 2025 or into 2026. It is highly variable, and it depends on how the inflation data come in. It depends on how the job market data come in. If we see a temporary increase in inflation, but then towards the fall we see that the monthly inflation numbers are slowing, then that would support rate cuts. I think the more likely outcome is that things are inconclusive, and that we probably don't see rate cuts until late in 2025 or perhaps in early 2026.
And to that point, too, we've seen consumer spending continue to be resilient over the last few years amid concerns about inflation. What data point do you think is the best for us to be monitoring to suss out if or when that consumer spending may start to finally take a crack?
It's the monthly retail sales numbers, which give us a pretty good indication of where consumer spending is going. And in particular, we're going to be looking at forms of more discretionary consumer spending. Are consumers spending more on restaurant meals, or do they feel stretched and so they're cutting back on those? What's going on with big ticket purchases, housing related items and so forth? If people are getting nervous, then that's where they're going to cut back. So it's those types of discretionary big ticket items, I think, that we're going to be paying the closest attention to.
Gus, I wonder, with all the different movements and headlines that are coming in around geopolitical tensions, especially as related to negotiations, what most notably should consumers be looking for to really understand when we do get a deal on any front, whether or not it's a good deal and one that should erase or mitigate some of their own concerns longer term?
I think it is a question of what's the effective tariff rate? And your earlier guest was talking about this. What are tariffs a month from now when we perhaps have a little more clarity relative to where they were at the beginning of 2025? I think, kind of try to ignore all the day-to-day stuff that goes up and down. But are tariffs substantially higher a month from now than they were before all of this? That is going to be, if they are, then that's a tax increase on consumers. That's going to be a drag on their spending. And that means trouble for the economy in the second half of 2025 as consumers adjust to those higher prices.
Gus, what's the probability of a deal before, and we have a month essentially until we reach the 90-day run out of the Liberation Day or post-Liberation Day pause?
I would say it's probably about 50-50, and a lot of it depends on what happens with the court case that we had last week that invalidated the tariffs, but then there was a stay on that. So do other nations decide that gives them a little more leverage, and so they can push for a harder deal, and the Trump administration says, no, we're not going to agree to that. So, the 50-50, but I think things could change very quickly as they have been throughout this entire process.
Gus, thanks so much for taking the time this morning.
Thank you.
Coming up, everyone, we count you down to the opening bell on Wall Street with stocks set to open in the red. We'll have all of your market action. Stay tuned. You're watching The Morning Brief. Now time for some of today's trending tickers. We're watching Tesla, Moderna, and DraftKings. First up, Tesla seeing a mixed picture for sales across Europe. Sales in Norway surging 213% from a year earlier, boosted by the revamped Model Y compact SUV. Meanwhile, sales in France plunged 67% year over year, with Tesla's registrations at the lowest level since July of 2022. Shares of Tesla, TSLA, they're moving lower by about 1.3% right now. They also saw some significant declines within the region of Sweden. Sweden was down 53.7%. You also saw move lower as well in Denmark, Netherlands, and then in Spain as well here.
Yeah, it's interesting that the sales in Norway were up a whopping 213% year over year in the month of May. So seeing that bifurcation throughout Europe. Having said that, Tesla is the biggest loser of the Magnificent Seven stocks this morning, down a little over 1.3%. And interesting to continue to see how their sales are struggling from a global perspective, even though Elon has gone back to the company, stepping away from the White House and his efforts with Doge, which some analysts told you and I, Brad, was part of the reason that we saw Tesla sales faltering on a global global stage, we do continue to see that happening. Of course, this data is backward looking, so interesting to monitor how those sales do going forward here. Well, next up here, let's talk about Moderna receiving FDA approval for its lower dose COVID vaccine for older adults and young people with underlying medical conditions. The approval is limited to people who have previously received a COVID vaccine. Moderna says the new vaccine should be available by the fall, though shares are up over 4%. Interesting to see that news of these approvals of COVID vaccines continue to move these stocks, given that in daily life, sometimes that can feel like it is a past chapter for some of these companies, but still obviously a huge potential revenue driver.
A past chapter of what's still very present technology that they're relying on to prove the efficacy and the ability to bring some of their future solutions to market as quickly and perhaps even get some of the similar type of emergency approvals going forward here. We do have a statement from Moderna CEO Stéphane Bancel. It's part of the news release saying COVID-19 remains a very serious public threat, with more than 47,000 Americans dying from the virus last year alone, and the approval giving a new important tool to help people protect themselves at the high risk of severe disease from COVID-19 here. So this is still critical as a technology play or a platform play for Moderna as well going forward. Finally, DraftKings. Those shares were sold by Two Sigma Advisors, the fund lowering its stake in the fourth quarter, and the company also taking a hit today after Illinois lawmakers passed a sports betting tax increase as part of the state's fiscal 2026 budget here. Shares moving lower by 5.5% right now, and this, of course, following that announcement with the legislation in Illinois that we were mentioning a moment ago, and it essentially would impose some additional fees for online sportsbook operators within the region.
Yeah, it's interesting here, taking a look at what's driving this. It's going to be a 25% tax. I'm sorry. It's going to be 25-cent tax on the first 20 million wagers accepted, and then a 50-cent tax thereafter, according to sources cited by Bloomberg News. This new effective tax rate is going to be in place starting on July 1st, so that is in part why we are seeing this move to the downside. We also did see a little bit of insider share selling when it came to DraftKings specifically, but of course, off of the back of this news of this tax increase that is set to take place in Illinois, we're seeing both DraftKings and Flutter under pressure this morning.
Yeah, B of A saying that this could change the effective tax rate for the company. Currently, approximately, they say about 35%, and it could go as high as over 50%. So that is a very significant consideration, and you're seeing shares react accordingly.
And you can see the QR code. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Campbell's is reporting better than expected third quarter results, benefiting from more people cooking at home as consumers seek value. Joining us now, Peter Galbo, BofA Securities food and beverage analyst. You've got an underperform rating and a $37 price target on Campbell's. How are you viewing these results?
Hey guys, good morning. Thanks for having me on. Look, I think if you peel back, a layer on the underlying results from this morning, what you'd see is that, look, the snacks business for Campbell's, which is brands like Snyder's Lance, Late July chips, is kind of performing in line with the category, which has been disappointing so far, and that was a continuation of the trend in the quarter and honestly on the go-forward period as well. As it relates to kind of the core, legacy Campbell's business that we would all think of, the soup business, now the Rao's brand, there was a bit of shipment timing that actually benefited the quarter, which the company, called out. Underlying trends on the base business were a touch better than what we looked for, but on the whole still remains pretty tepid from an overall standpoint.
What do you sense about the consumer, the health of the consumer, as according to the gospel according to Campbell's, if you will?
Yeah, I think what we're seeing, Brad, as it relates to the consumer as a whole in staples is that staples have been, frankly, less stapley than we would have otherwise noted. And I know that's not, the technical term, but what we're seeing really is probably more discretionary activity on the part of the consumer in these consumable categories that are more everyday usage. And that continues to be the case, particularly in categories like snacks.
And talk to me about that category specifically. One of the big questions has been whether or not we're going to see a negative draw on companies like Campbell's due to the increased usage of GLP-1s. Are we seeing any evidence of that yet?
So it's a great question, and it's one that we've tried to really dig into a bit on. I think what you're seeing in the snacks category as a whole, and this is emblematic of what we've seen out of names like Pepsi, who's the largest snacking player, Kellanova, which has a large snacking business, Campbell's. It's really more probably a function of the price point. So you've seen collectively, the snacks category take something like 30 points of pricing, or even a bit more than that over the past 4 years. While the consumers' wages just simply haven't kept up. It was part of our thesis underlying our downgrade of Pepsi last month. Was simply just, look, wages have not kept up with the pricing in snacks. It's a more discretionary purchase. And so, it's going to take, a price correction to some extent on the part of these companies, whether that be in pack size changes or in actual list pricing to try and stimulate consumer demand.
Pack size changes, does that mean shrinkflation?
Pack size changes can mean a number of things, but really what it is it's trying to hit a price point. So if a consumer only has $2 in their pocket, it's about hitting a pack size that is at that price point.
As you talk about price point, one of the things that they mentioned was unfavorable net price realization here during the quarter. How much of a headwind or an extended headwind do you see that being?
Yeah, it's a great question, and it gets back to the point I was making about what are these companies going to do going forward? Mm-hmm. Do they capitulate kind of on pricing, and that becomes a margin headwind as a way to try and stimulate volume demand? It's something that some of the snacking companies experimented with last summer. Again, think about it. Snacking becomes a really important category in the summer as we think about barbecues and summer holidays. And look, what happened last year when they tried to promote is it didn't necessarily give an overall lift to volume consumption or consumption in the category. And so it really becomes a question of, do they revisit that thesis again now that we're another year on? Or do they kind of wait out the storm and hope that we get wage increases again to kind of make up for the pricing differential?
And we're about a year into Campbell's acquisition of Rao's sauce. How has that impacted the business? And also, I should mention, I'm seeing some commentary from our Yahoo Finance users on our platform that there may be some skimflation going on in the sauce jars, according to them. So we'll have to fact check that, Peter. But what are you seeing?
So look, in terms of Rao's, this, going back to the time of the acquisition, this made a lot of sense. It's a category that Campbell's plays in materially. With the Prego pasta sauce brand, this was a much more premium offering that they could look to add to the portfolio. It's a totally different process, right? The product is made in Italy and imported from there for the most part. So a bit different from what you might be seeing on some of the lower priced pasta sauces on shelf. It's been a good acquisition. The sales growth has continued to be strong. What we've seen though recently, again, as that price point has remained in some cases $8, $9, $10 a jar, you've seen some of that consumption really slow, and as some of the distribution opportunities from Rao's have really kind of hit their limit. There's probably room for more consumption on the part of the consumers, but in terms of expanding distribution, we think that's a bit more limited going forward.
Lastly, while we have you here, Peter, you think about the snacks business, and I know you brought this up earlier, but they had a recent divestiture of Pop Secret as well that they acknowledged within the earnings. Going forward here, I mean, you've got some other kind of core snack brands that are essential or at least household names, Goldfish's, Snyder's, so forth. As you think, even Lance, as you think about all of those names, is it an opportunity to divest from an additional snacks name in this case?
Yeah, Brett, I think the core category that they have, right now is probably what makes sense. Popcorn was just not really a core competency for them in terms of how it's distributed and the growth prospects of that category. I think the others, just from a revenue-based size, are probably more core, at least at this point.
Yeah, I haven't been doing them any favors on the popcorn side myself, so makes sense. Peter, thanks so much for taking the time.
Thank you.
All your markets action ahead. Stay tuned. You're watching Morning Brief. Just moments away from the opening bell, there you see a live look at the New York Stock Exchange and in Midtown Manhattan at the NASDAQ. Great bell ringers on both sides. You've got Charles River Associates ringing the opening bell at the NASDAQ. And then you've got Diamond Rock Hospitality ringing the opening bell at the NYSE. You hear the bell, you see the funfetti. We've officially begun trading for the month of June. Let's take a look at the major averages as we begin today's trading activity and this new trading month. The Dow Jones Industrial Average starts off the month down right now by about 0.4% just after the opening cross. A lot of trading session, a lot of month left. We'll see what happens. The NASDAQ 100 here, we've got that pulled up on our screen. You're seeing seeing that lower by about 0.1%, higher year to date by about 1.5%. And the S&P 500, you're seeing that's lower to start off the day by about 0.3%. I want to get you a quick look at the NASDAQ composite too, just so you get a gauge of the entirety of the 3,000 plus companies that are traded within that composite. And there you're seeing it down by about 0.2%. All right, taking a look at some of the heat map activity here. Let's get on away from this crypto. We'll come back to this if we have time in a hot second. But here are the 11 S&P 500 sectors to begin today's trading session. Energy leading the pack. That's up by about 1.7%. However, you've got more laggards than gainers. And the granddaddy of the laggards, at least out of the gate, is communication services. That's down by about 0.8%. Also within that category, real estate, utilities, and staples. However, taking a look at some of the tech names within the NASDAQ 100, you've got NVIDIA starting off the session higher by about 1%. You've also got Apple, AAPL, that's moving up by about 0.25% right now to begin today's activity here. A few other pops of green scattered in, but oh yeah, folks, you've got a lot of red to start off the trading session here. It seems like the biggest of the decliners right now in the form of Adobe. You've also got Alphabet, that's lower by about 2% to start off today's trading activity. I want to take a look at the Dow 30 components here in our heat maps since we've got them up. And again, more red than green, and NVIDIA, one of those bright spots. Also United Healthcare. However, I'm sure that one is happy that the month is over, the month of May at least here. Taking a look at the past, let's take a look at the past month, why don't we, if we can pull that up. 1 month here, and over that previous month period, we've seen that move lower by about 23%. We'll see if we can see more of a bounce back there. And then just lastly, since I promised it, and since we teased it, and since you had it up on the screen, I want to deliver and keep my promise here. Bitcoin, you're seeing that lower right now. Of course, the Bitcoin and cryptocurrency markets don't ever close, but right now it's down by about 0.2% over the past 24-hour period. Past month, it's been a good one. Did get back to some all-time high levels you did see towards the back half of May, and we will see exactly what June holds for the cryptocurrency. With that, I'll toss things back on over to you, Maddie.
All right, Brad, thank you so much as always. It's time now for today's strategy session. The market mantra of sell in May and go away didn't work out too well for investors last month. So how should investors position for June, which is historically a weaker month for stocks? Joining us now, we got Larry Tentarelli, Blue Chip Daily Trend Report's Chief Technical Strategist. Larry, it's great to speak with you this morning. This May was the best monthly gain in 18 months. When you see a record rally like that, how hard is it to get a sequel?
Good morning, Maddie. I don't think that we should expect another 5% or 6% upside month, but I do think that there's a lot of bullish momentum in the markets right now. And if there was any type of consolidation or a reset, I think it would be a viable pullback.
Larry, I wonder, what is the kind of key technical indicator that you're looking at amidst some of what the analysts and investment strategists that we've spoken with are anticipating in a longer period of chop or volatility?
So the trends are very strong right now. The S&P 500 and the NASDAQ 100 are both trading over the 20-day, the 50-day, and the 200-day moving averages. So that indicates an uptrend on multiple time frames. We've got bullish weekly momentum, and we could see some chop into the summertime. After such a big move in the indices, some type of a digestion period would not be uncommon, but I think it's something that we can buy into.
You said that, yeah, I hear you saying buy into the rallies. What does that buying look like? Are you buying into the Mag 7 that have once again emerged as the majority of the responsibility for the gaining in the S&P 500, or are you looking at the other 493? What's that looking like?
So the top ranked sectors for me are technology, industrials, and consumer discretionary. I'm not so much a fan of the entire Mag 7. I've got a position in NVIDIA. I've got a position in Tesla. I think those are two high upside potential ideas. The industrial sector has been very strong. Consumer discretionary has been very strong. And as long as the jobs market holds up and the economy holds up, I would expect those three sectors to lead.
Larry, I put one stat at the top of my notes. It's not deep, it's super high level, and it comes from FactSet. 98% of the S&P 500 companies have reported earnings. So as we're essentially with earnings season in the rearview mirror, a couple household names are still going to be kind of rolling out results here and there. But all things considered, how does this set up, especially knowing the guidance coming off of this most recent earnings season, What's that setup look like for the summer? Are we due for some perhaps relief rallies if companies come out and say, all right, things weren't as bad as we had forecasted, and we can also offer a bit more guidance going forward from here?
I think that it's very possible that we could get a relief rally. At the end of March and going into April, the markets had really priced in a worst case scenario from the tariff news cycle, and we haven't seen that worst case scenario play out as of yet. Earnings have come in fairly strong. So I think as long as earnings hold up and we don't get any major downside surprises or we don't get any major step back in the tariff news cycle, I think that does set us up for higher.
Larry, those are some pretty big ifs, especially given some of the headlines that we've got with the U.S. and China, both saying that each other is failing on their side of the trade bargain. How are you thinking about how risky tariff policy is going to be to this market over the course of the summer here?
There's definitely risk. So as you can see, we've got a very high volatility news cycle. Luckily, the news cycle over the past month or so has been positive, but there's always risk. We should expect 1% to 2% daily ranges in the S&P 500 on any major headline. So I think that's something that we want to keep in the back of our minds, but until it happens, I wouldn't spend too much time focused on it.
Larry, just lastly, while we have you here, I know that Palantir, as we know, is one of your top ideas here. And for Palantir recently getting more government contracts, and we know that this is a space where they highly rely on government contracts for their future recurring revenue run rates as well. They just got this new partnership. It seems like they're working even more so with the Trump administration and, setting aside any of the concerns around surveillance of citizens. It seems like that is where they're going to be leaning into some of those relationships with the administration to garner even more of their revenue base. I just want to get your kind of updated assessment on them.
So Palantir, still my favorite tech idea, and I think they're really in a sweet spot. They dominate their industry, they dominate big data and AI, and they are tied in with some very high value contracts with the US government. So that is definitely a bullish tailwind. And unless there's some type of a major step back there, which I don't expect due to the stickiness of their relationship with the government, I think that sets the stock up for higher.
All right, Larry, we'll continue the conversation here. Thanks so much for joining us here. Appreciate it.
Brad, thank you so much.
Let's get to three market movers that you need to watch for the trading day. Yahoo Finance's Jared Blickery has more.
Thank you, Brad. Welcome to the month of June. We're going to talk about seasonality a little bit, especially in 1 hour, but we'll go over some of the details in a minute. Then we're going to talk about the slumping dollar and also surging commodities, particularly the metals, but also crude oil. And finally, we're going to take a look at Bitcoin, which is having a little bit of a rough go right now. But let's start with the major indices on the Wi-Fi Interactive behind me. You can see the NASDAQ here is the only one of the majors up in the current early trading here. It's up about 1/3%. We can take a look at the Dow. That is down about 0.4%, and the S&P 500 down 0.8. And one of the things I'm going to be looking at shortly in the 10 a.m. hour here Eastern time is June seasonality after we have a really big pop in May. Now, as it turns out, June is usually not one of the greatest months of the year, and even after a strong May like we just had, it's still not one of the best months, although usually positive. So we have some other factors that could dominate. Tariff headlines are always going to be the most prominent thing top of mind, and they have overridden seasonality before this year in April, to be sure, but we're going to go over those details shortly. Also want to take a look at the sector action, get another look at that as we are a few minutes into trading. Energy is up by over 1%, and that is on the back of crude oil. WTI crude oil is surging the most in a few weeks here, and also in the green, tech and materials. And as I was just taking a little look at some of the heat maps here, I want to show you the Dow versus the transports. Here's the Dow. You can see the mega caps largely green. Some of the smaller ones to the right, it looks like red is dominating. But here are the transports. Everything except for KEX there is red, and including Uber and UNP, Union Pacific, which are the largest stocks in those indices. But I want to get now to the futures market. And first, we're going to dial up the dollar because that is sitting at year-to-date lows lows or near lows, and that's something we want to keep in mind here. A lot of times the lower dollar or the sinking dollar, the weaker dollar can be thought of as risk on, but in the case of tariffs, sometimes if the world is selling everything, particularly the US dollars, you don't want to see that. So a little bit of a hiccup there to be concerned about maybe, but if you're looking at the commodities action here, not too much of a hiccup at all. Let's take a look at gold. That is up 2%, and this is a year-to-date chart, up 27%. This is the highest price that we have seen in 2 weeks, and it is getting very close to those record highs, right around $3,500 per ounce. And I said the metals complex is surging here, led by copper. Copper is up to a 2-month high, as is silver. Both of the charts looking somewhat similar here in terms of their breakout. Multi-month breakout here in copper, although it has backed off some of those highs. And then in silver, actually looking a little bit stronger. Silver's up about 3.5%, up 15% year to date. Now we got to go to the crypto market. And Bitcoin has turned positive now, but it is still right around 104, right in the middle, 105,000. One of the things that was kind of concerning me about crypto and the leader in Bitcoin is that it has a history of breaking to new highs and then immediately performing some kind of a rug pull and then leading the way down. And so far, we have broken this trend line here. And as long as we are under about 105,000, that gives me a little bit of concern that we might see a more protracted sell-off in Bitcoin. But to be sure, I mean, you look at this chart here, let's look at the 2-month chart. This is a bullish chart, and I don't want to cast too much shade on this rally here. Ethereum had been down earlier, but it's turned positive. But the other thing that I'm looking at is the 5-day performance. We've seen a lot of weakness in altcoins, and sometimes when we see that negative breadth in crypto, that can also be an ominous sign. So I'll be watching crypto, Bitcoin particularly, around 105,000. Maddie?
Jared, thank you so much, as always. We've got all your markets action ahead here at Yahoo Finance, so stick around. You're watching Morning Brief. Big pharma deals coming out as global giants attend the American Society of Clinical Oncology's annual meeting in Chicago. Sanofi agreeing to buy immunology company Blueprint Medicines for over $9 billion. Meantime, Bristol Myers Squibb will pay BioNTech up to $11 billion to license a next-generation cancer drug. Joining us now with more on what's to come out of this big pharma event, we've got Evan Siegerman, BMO Capital Markets Managing Director of Biopharma Equity Research. Evan, great to speak with you here. I do want to start on this deal for over $9 billion here. What does that signal for you for the rest of the sector?
So I don't cover Sanofi, but I can talk more broadly about what it means for the space. And it's great. We love to see M&A. There's been a bit of a dearth in big M&A. And this is a nice sizable deal. I know a lot of the companies that I cover talk about doing deals in the $10 to $15 billion range. And it signals a few things. One, that there are biotech companies producing great data. But two, that the big players are comfortable, diving in a little deeper, spending $9 billion, not just spending $500 million. So I like to see that because that is the lifeblood of the sector.
Evan, to what extent do you believe some of these deals are either reactionary or trying to front-run any potential moves from the administration on policy?
Hard to say. I mean, a lot of these biopharma companies that I cover have holes in their pipeline. Look up Merck, for example. Keytruda goes off patent at the end of the decade. They're going to get hit by the IRA at some point. So they really need to, backfill that. Same thing with Bristol, which is why they decided to license in the asset from BioNTech today. And I also highlight, not in the oncology space, but Regeneron had a huge move last week to the downside and opting into in-license and obesity assets. So, more moves than just the Sanofi asset the Sanofi deal you had mentioned.
And when you think about regulation more broadly on the sector over the course of the next 4 years, how do you think that it's going to net out in terms of how that regulation may impact this kind of deal making going forward?
For sure. So I think generally the FTC right now is a bit more deal friendly, but who knows? In terms of FDA, it seems that, even with all the talk, it is a lot of, business as usual, especially when we talk to the companies that we cover. A lot of their interactions haven't really changed. That's more headline risk. I think the big unknown is any sort of drug pricing reform. Remember, we had the EO a few weeks ago. Folks were concerned that that could lead to what's called most favored nations pricing in Medicare. Still haven't seen much on that front. I'm of the belief that it doesn't end up amounting to much, probably more headline risk than anything at this point.
This was seen as one of the most investable sectors coming into the start of the year. Is it still that, Evan?
I'm still positive on biopharma, as I am a biopharma analyst, but I do understand some of the headwinds. I think folks have been spooked just when it has come to the drug pricing issues, the potential for tariffs. But hopefully, as that comes, is behind us, folks will be more interested in investing in the sector. And you see deals like this, which shows that there is, a pulse, and these companies are actually, moving forward.
How much of the capex do you expect that if they're prioritizing more of trying to partner up or consolidate efforts? What does that mean for their own research and development capital expenditures as you're measuring them?
So, I think R&D budgets for these companies remain relatively stable, right? They kind of set that out at the beginning of the year. Mm-hmm. These companies do invest a lot, especially if you even buy an asset, because if you're a big biopharma company, you got to run that phase 3 trial. So that's R&D. In terms of CapEx, a lot of the companies I cover have announced additional manufacturing investment in the United States. That's probably to placate the administration. I think that, we do expect these companies to continue to invest in the United States. Lilly, upwards of $40–50 billion, all companies across my coverage do that. So bottom line, a lot of investment in R&D, a lot of investment in CapEx, and hopefully some more deal making.
And so if those manufacturing capacities come online, now we're talking about overhead, we're talking about staffing, we're talking about, just being able to continuously utilize that or make those assets make sense to investors. Right. What are kind of the longer term returns that you're starting to model and bake in as we're seeing some of those announcements?
Well, in biopharma, you got to make your product somewhere. So, a lot of these companies do manufacture in the United States, and they do want to bring some of that bring some of that international manufacturing back here. A lot of manufacturing also happens in Ireland, so there could be a shift to that. Long way of saying that if they have drugs to sell and they can keep selling them, they will keep making them. The cost to do that is lower than what they will generate in profits or in revenues from selling the drugs. So, it is an okay thing to see, and I think that investment is very healthy for the sector.
Evan, good to see you as always.
Thank you so much.
We look forward to seeing some of your updates from the conference.
Sounds good.
Thanks. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Steel stocks are rallying after President Trump said tariffs on imported steel and aluminum would double from 25% to 50%. The president saying the hike will, quote, further secure the steel industry in the U.S. Those changes are expected to begin on June 4th. The move escalating tensions with the U.S.'s top steel trading partners, including Canada and Mexico. Analysts making some calls in light of the news. We got BMO Capital Markets upgrading North Carolina-based steel producer Nucor to outperform from market perform. But Canada's Algoma Steel is getting cut to market perform from outperform due to its exposure to the U.S. and, of course, due to these higher import tariffs.
Also in commodities activity, oil prices jumping as OPEC Plus increases supply amid geopolitical concerns. The organization raising its output for July by 411,000 barrels per day for the third consecutive month. There was some disagreement over the latest hike, with few countries lobbying for a pause in July. In part, the rise in oil prices is also attributable to an unwinding of bearish bets ahead of the decision following reports that the group was considering an even bigger supply hike.
And let's get you a check-in on the major averages here, just about 30 minutes into the start of your trading day and your trading week in a new month here. You got your S&P 500 off about 0.5%. Your tech-heavy NASDAQ down just about 0.2%, making the Dow look a little bit worse here this morning as we continue to see that dislocation in that relationship here. Among the Mag 7 members, Tesla is the biggest loser of the morning, down a little over 1%. You can see that weighing on the tech trade here. But let's take a look over at the bond market, which is going to be responding to the economic data as we get it in this week, chock full of that economic data. You've got everything from ADP to jobless numbers and, of course, to that critical jobs report coming out here on Friday. But taking a look at your 10-year yield, it's up about 3 basis points. We continue to see that growth on the longer end of the curve with your 30-year yield up about 5 basis points, but still holding below that key 5% level. Having said that, we did have JP Morgan CEO Jamie Dimon calling for cracks in the bond bond market to come. And he, of course, said that the bank was well positioned to handle any of those cracks. But it's, of course, something that investors are going to continue to monitor going forward, and something that we will continue to speak with our sources about, because if yields get too high, they might become a little bit too attractive for investors to be able to afford to stay out of them by staying invested in stocks. That's going to do it for the morning brief this morning. You can join me for more analysis in the next hour on Catalyst, and then Brad at 11 a.m. Eastern for Wealth. After that, stick around.